Hello everybody and welcome to our Module 7 discussion of revenue and the income statement. So as an overview of the income statement, first of all we have a few different terms that are sometimes used for this statement. Now we just have a couple here, the statement of operations, sometimes the profit and loss statement, although that second term is a little bit more commonly used as an internal managerial accounting term, but occasionally you might hear it called that. And again, there are a variety of other terms, but these are a couple of them. So the purpose of this income statement is to show the revenues and the expenses of a company throughout a period of time, whether that be a month, a quarter, or a year. Now the idea here, most companies certainly are looking for profit. They want their revenues to exceed their expenses, and that gives them net income, which is a positive amount. If they had a bad year and their expenses were greater than their revenues, then that would be basically a negative net income, which is referred to as a net loss. Now what I want to mention here is the income statement. It's not just showing the cash revenues and the cash expenses, at least under GAAP, generally accepted accounting principles. It's showing the revenue that's earned and the expenses that are incurred throughout that period. We'll talk more about that in just a bit. But I do also want to mention that there is another statement that does indeed show cash only, and it's the cash flow statement, which we'll cover next week. So the income statement we're going to see is generally reported under the accrual basis of accounting. We'll talk about what that means, and the cash flow statement is by its nature under the cash basis of accounting. So when we talk about revenue, we are talking about what a company does for their core operations. They earn revenue when they sell a product or when they provide a service to a client or customer, and either they receive cash or they create an account receivable, or they might even satisfy an obligation. That last one comes when the customer is already prepaid, and now we are earning the revenue by providing the service. The cash has already changed hands months ago, perhaps, but now we're earning it by generating the service, providing the service, delivering the product, and we're satisfying that liability, that obligation that we owed to the customer. So the way we record revenue is based on the amount of cash that either is received or the amount that's expected to be received related to that transaction. Now again, the first piece is all about the timing. The second piece here is all about the amount of revenue to record. So we have a couple of different criteria that have to be met. First of all, that revenue has to be either realized or realizable, and it has to be earned. So as I just mentioned, it's the amount and the timing. Now the earning is what we tend to focus on the most because it's all about the timing of when can we generate that revenue, when can we record that revenue. Now most companies, they generate the revenue pretty quickly. They provide the service, they deliver the product, and it's done. Sometimes that's referred to as the point of service method. That means you've provided the service, and at that point you generate revenue. However, there are some companies, some industries that have a longer process for recognizing that revenue, for earning that revenue. So think of a construction firm. Their revenue earning process can take multiple years in some cases. If they have a big project that's going to take 2 or 3 years to build, they need to know how much revenue they've actually earned along the way in each year. So there are a variety of methods that can be used to go through that. Now what I will mention here is that I'm just introducing these topics. These are actually more intermediate accounting topics. For this level of course, we are just introducing the concepts and the terminology. So the percentage of completion method basically says we take a look at how many of the expenses we've incurred up to this point, salaries, materials, things like that, compared to what is the total amount we think we're going to incur over the entire project. Whatever that percentage is, that's the percent of revenue we'll record as well. So that does a pretty good job of matching revenues and expenses. With the installment sales method, we collect money on that contract at regular intervals to help us pay for the expenses, for example. And we record both some revenue and some expense with every collection. and along the way we record profit as well. With the completed contract method, we're saying that there might be quite a bit of risk that we may not actually collect all of this money. So with the completed contract, we don't record the revenue until the project is done, is completed. So it's just like the point of service method, only it's for a long-term contract. Now that is less commonly used, but it is used when there is a lot of risk with that project. So some additional terms that are sometimes used for revenues, we could have earnings, we could have fees earned, sales. It really depends on what type of company we're dealing with. But what I do want to focus on or point out is the fact that revenue is not the same as profit. Revenue is not the same as net income. Revenue is the starting point, but before you can get to net income or profit, you have to subtract out expenses. But the key thing with revenue, regardless of what you call it, is we have to know what the company's core operations are. What are they in the business of doing? When they do that and when they earn the money for it, that's a revenue. We're going to talk about different things that the company can earn outside of their core operations, and those would be gains. Now, another thing when we talk about revenues, this is unfortunately a common way that an unethical company might try to commit accounting fraud. They either accelerate the revenue, so they try to record it this year, even though the service won't be provided until next year, or the product won't be delivered until next year. They record it this year because they're trying to improve this year's bonus. Now, there are some situations where they may try to delay revenue, which sounds counterintuitive, but the reason they may do that is that if they've already had a great year this year, they've already exceeded their target, and maybe they've already exceeded the maximum amount of their bonus that they could get, they might be tempted to delay any excess revenue to the next period. That way it won't set their bar so high next year, because if this year we had a high amount of revenue, next year we might expect it to be even higher. So by delaying the revenue, they might be trying to start the next year early. Even though these two are opposites, accelerating or delaying revenue, both of them are improper. The point is, revenue has a specific time when it should be recorded, and it's when it's been earned. When we've delivered that product, when we've provided that service, whatever we need to do to earn our revenue. So now let's switch gears and talk about the other side of the transaction, the expenses. So in order to generate revenues, the company has to incur expenses to run the company. Very few, if any, companies, and really no companies, can generate revenue without any expenses whatsoever. Even charities that operate on a lot of donations, they're not going to have every single thing donated to them. They're still going to have some supplies or maybe some salaries somewhere that they're going to have to incur, some overhead. So virtually every company is going to have some level of expense, and the question is, when do we report the expense? The point we want to make here is we record the expense, we try to record the expense in the same period as which we earned the revenue. That way we have a good idea of what our true net income was. The true revenues minus the true expenses gives us our net income. This is referred to as the matching principle, and it's all about timing for when we record that expense. Some really good examples we have here are when we sell inventory and when we record the cost of goods sold related to selling that inventory. So the cost of that inventory is recorded as an asset until it's sold, and in that same period we record the related expense, cost of goods sold. So now we'll talk about the other types they're similar to revenues and expenses. We have the gains and losses. Earlier I said that revenues are related to our core operations, but there are some other ways you can earn money, and these are gains, and then of course the flip side would be a loss. So gains are similar to revenues, they're positive, but the big difference is where I said revenues are related to the core operations, gains are not. They're related to some peripheral transaction that just so happened to occur that period, but it's not something we normally expect to occur. We sold some fixed assets that we're no longer using. We sold some investments, and we generated a gain. Now, That would be, for example, if you sold the asset for more than what it is reported on your books at, that would be a gain. But the flip side of a gain is a loss. It's really the exact opposite. They could still occur from those same fixed asset or investment sales, but it would be if you sold them at a price lower than what you had recorded on your books. So here we have a very simple example of what's known as a single-step income statement. And the term single-step means we really only have one profit type figure, and that's net income. So here with the single-step statement for this entire year, we're listing out all the revenues we have. There are two different types of revenue, some sales, some service revenues. We get a subtotal. Then we list out all the expenses, including the cost of goods sold. I want to point that out explicitly because we're going to see that in the next slide in a different place. So cost of goods sold, and then we have a variety of other things. Research and development, selling, general and administrative expenses, income taxes. We get a subtotal. We subtract the two and we have net income. With the multi-step income statement, it's a little bit different. We're still going to have the same net income, but we've reorganized things into various classifications. We have various subtotals. The most important one to point out here is that immediately under sales, we have the cost of goods sold that we're subtracting out. Remember, that's an expense, but it's the expense directly related to those sales. We subtract that out, and we get a subtotal called gross profit or gross margin. So that's not the bottom line. It's just the profit left over after only accounting for the expense related to the cost of goods that we sold. After that, we have a variety of other operating expenses, research and development, selling, general administrative expenses. We'll do a subtotal there. And then we have operating income, a subtotal. And we might have some other income. Interest income, for example. There might be some gains and losses here. We have $2,000 of that. So we'll add that in and get another subtotal, the income before the provision for income taxes. And then we subtract out our income tax expense. And we arrive at a net income figure. Now we're going to move on to the components of that sales figure that we were talking about. Notice up here, we just said sales in general. We didn't really use the term gross or net. In reality, a company needs to know the difference between gross and net sales. Gross sales are the actual total dollar amounts that that were on the ticket, so to speak. So this is what the customers purchased, but there are a variety of things that might reduce that price. Now, we're not talking coupons or in-store discounts or things like that, or even volume discounts. If they buy so much, they get a discount. This gross sales is after considering those reductions. In other words, this is what we have charged the customer initially when we ring it up. Now, we're going to subtract out sales returns if they happen, sales allowances, and I'll talk about that in just a bit, and sales discounts. Sales allowances are basically where the customer is dissatisfied with the product slightly. Maybe it's the wrong color, the wrong size, slightly the wrong thing, maybe it's slightly damaged. They have the option where they could full-on return it, or they could just keep it but negotiate a slightly lower price due to the damage after the fact, after the sale. So it's a reduction in price that's due to some sort of damage. Sales discounts here, this is when we charge the customer for the full price, but we said, hey, if you pay us early, within 10 days, for example, we'll give you a 2% discount. Now we have net sales. Most companies on their income statement, they tend to report net sales, and then if you wanted the details, you'd have to go to the footnotes to the financial statements. So now we're going to focus in on sales discounts. The returns and allowances are pretty straightforward. We're going to focus in on sales discounts, and this brings up another term called FOB, free on board. Sometimes in some texts you'll hear it referred to as freight on board. But free on board is the original acronym, and it actually makes a little bit more sense for what we're talking about. We're basically saying, the way to describe free on board is from the buyer's perspective, this shipping, this product is free to them shipping-wise until it hits a certain point. And at that point, they have to pay the shipping cost. So if it's FOB destination, from the buyer's perspective, it's free on board for them until it hits the destination, which might be right outside of their warehouse. So if that's truly free, it's completely free on board for them in that case. The ownership, the risk of loss, and the cost does not transfer from the seller to the buyer until the final destination. The FOB shipping point means that it's free to the buyer only up to that initial shipping point, which in a way really means it's not free at all. The seller's just saying, hey, I'll take it to the loading dock, to the shipping yard, whatever, and after that point you pay the shipping. If it gets lost, it's your responsibility. So the seller is hands-off, risk-free as soon as they get it out their door. So that's the difference here. One other important thing this determines is who owns the product while it's en route. If it's FOB destination, the seller continues to own the product until the very end. And if it's FOB shipping point, the buyer owns the product even though they haven't seen it yet. So for inventory counting purposes, that's going to determine who needs to count that inventory. Someone needs to count the inventory for sure. Some of the other components that we talked about, we have the cost of goods sold. Now again, that was the cost that we paid for the product to buy it, to sell it. There might also be costs related to inventory shrinkage, obsolescence, breakage, theft, things like that. We still have to record that as a cost of goods sold. So part of this depends on whether we're using the perpetual or periodic method. Now I know this goes back to our inventory discussion, but if we're using the perpetual method, we're going to record a cost of goods sold every time we sell a product. But if it's the periodic method, we only do it once per period. And in that case, we have to look at these calculations. To get the cost of goods sold, we take the beginning inventory balance plus our net purchases, which we'll see in a bit. That equals the cost of goods available for sale that we could have sold, but we subtract out ending inventory because we did not sell that, and that tells us what we did sell, the cost of goods sold. Now the net purchases calculation is very similar to the sales calculation, the net sales calculation. It's the original cost of the purchase, plus we're adding in any freight charges that we had to pay. We're subtracting out discounts, we're subtracting out returns and allowances, and we get a net purchase figure. And gross profit, of course, or gross margin, either term works. That is the sales, the net sales, if you will, minus the cost of goods sold. Yeah, that gives us our gross profit figure. Now we're also going to have some non-operating items. So first of all, we do have income from operations, or operating income, that's another term. It's sometimes even also referred to as earnings before interest and taxes, EBIT, EBIT. If you're in investments and you're looking at a company, this is a commonly used phrase. And this is before considering any other things outside of our core operations. After this profit figure, we have other income and other expense. There might be interest, either income or expense. Gains would be kind of like an income. Losses would be like an expense. These are not operating related, but they're still important to record. And then our income before taxes, subtotal. And then we're going to record income tax expense and subtract that out, and then we get net income. Now, at the bottom of an income statement, you're generally also going to see another calculation, another note, if you will, another amount called earnings per share. From an investor's perspective, this is your way of knowing how much of that earnings is kind of yours. That doesn't mean you have full access to it right away necessarily. Doesn't mean the company has to pay you that money, but it's the value that's accruing for every share of stock, essentially. It's just a metric that they use. You may get it all if the company pays out 100% dividends, or the entire thing may be reinvested in the company and the stock value grows. It just kind of depends. But it's still a good metric to know how much value is accruing on your behalf. So it's going to be calculated by taking the net income available for common stockholders, which this is net income minus any preferred dividends. The idea here is that this is for common shareholders. Preferred dividends, they do not have access to. That's going to be paid out to the preferred shareholders. So we have to subtract it out, even though it's not a true expense. We get a net income figure for common shareholders, and we're dividing it by the weighted average common shares outstanding. It's not just simply the number of shares at the end of the period. It's on average throughout the year, how many shares did we have on a weighted average? Now, if this company has 10,000 shares throughout the entire year and it's never changed, then yes, it's just simply going to be the ending balance. But let's say they had 4,000 shares for half the year, and then 6,000 shares for the next half, another 6,000 shares for the next half. So they had that 4,000 throughout the entire year, and then they added 6,000 shares in the last half of the year. The weighted average would basically be the full 4,000, the full 4,000 plus half of the 6,000 shares that we added at the end of the period. That's how you, and then you divide by 2. You add those two together and divide by 2 to get a weighted average common shares outstanding. Now we have 2 additional slides here. One of them talks about some unusual income statement items that are actually going to show up on more complex income statements. Some companies have them, some only have them temporarily. We might have discontinued operations. If a large company with many different product lines or divisions, if they decide to get rid of a division, then they want to make sure shareholders realize that whether this final year for this division was good or bad, the shareholders need to realize that it's not going to exist into the next year. So things are definitely going to change, good or bad. So that's the discontinued operations. Extraordinary items are things that are both unusual and infrequent. And again, it just so happened this year it's most likely a loss, but it could possibly be a gain as well. You need to report it, but you also need to let investors know that this is extremely unlikely to happen again anytime soon. Think about a hurricane. A hurricane in Florida, depending on the size, it's unfortunately common, fairly common, so that would not be extraordinary. But a hurricane elsewhere that just normally does not get a hurricane or any large damage, then it might be considered extraordinary. Cumulative change in accounting principle. This is where the company has decided to change, for example, their inventory method, usually their inventory method, that's the general thing that gets changed here. And they've changed it, and now it's resulting in completely different numbers because of this change. So what they have to do is they have to restate all of the prior years that we're referencing in this year's statement, which generally is 3 to 5 years. They have to restate those years so they're reported under the same principle that we're now using, same calculations. And the cumulative change just shows how those 3 to 5 years have added up and what impact they had on the total net income. The other unusual item you might see is if you have a company that owns a subsidiary, let's say they own 90% of it. If they owned a full 100% of it, then it's very easy to consolidate. But if they own 90% of it, or 70, 50, all the way down to about 50, then what they have to do is they have to report 100% of the revenues and expenses of that subsidiary as if it was all theirs, but then on one line item, they have to back out what's called the minority or non-controlling interest in the earnings of subsidiaries. That 10% that's not theirs, they back out. They show investors that, hey, this is really not ours. We need to let you know about that. And the final item I want to talk about is comprehensive income. There's something known as a comprehensive income statement or other comprehensive income. This is an expansion above and beyond the normal income items that we report. These are items that are not yet truly realized, so they can't be counted as regular income, but these could be realized at any point the company decides. There are four main things that get included in comprehensive income. A couple of them are actually related. The first two are very closely related, similar types of items. They are unrealized gains or losses on a certain type of investment, an available for sale investment. It's one that we're not actively trying to sell, but we're also not intending to necessarily hold it until the maturity date. So it's out there. If the price is right, hey, we'll sell it. It's available for sale. Any gain or loss, so we compare the fair market value of that investment to what we've got it recorded at on our books today, and we basically say, if we sold it today, what gain or loss would we have? That's unrealized because we haven't sold it, but it's a what if. The hedging derivatives are another type of investment, same basic idea. Foreign currency translation adjustments. Think about a large company that has subsidiaries all around the world. Those subsidiaries in those foreign countries likely hold a substantial amount of their local currencies or their local country's currency because they need it to operate in that country. It makes sense. What this translation adjustment is basically saying is, what if the company forced all of its subsidiaries to cash in whatever their local currency is and translate it all back to the dollar? Some of those trades would have gains, some would have losses, just depending on the market at that point in time, the currency market. And this is the recording of those net gains and losses. In other words, if you sold it all for the dollar, what would you get? Unrealized gains or losses on post-retirement benefit plans, pension, basically. So these are all estimates. We have estimates that we record expenses and assets and liabilities for pension. We basically say if or when everybody retires, in different years. Some people are retiring next year, some people are retiring 10 years from now, some 30 years from now. But when everybody starts to retire and we start to pay them their pension, how much money would we owe? This particular thing is basically saying, if you owed everybody their entire pension today, in other words, you bought them out for whatever a fair value would be, how much of a gain or loss would we have? And that's what that is recording. So that takes us through the income statement and revenue. Hopefully this has helped to clarify some of these topics. Again, in intermediate accounting, you get into a lot more detail with this comprehensive income, the long-term revenue recognition methods, and things like that. But I thank you for your time, and I look forward to talking to you in our next session. Have a good one.